As we analyze cost behavior, we can start to explore ways that managerial accounting can be used to make marketing decisions. For instance, by understanding the relationship between sales and fixed and variable costs, we can determine how income or profit would change if we change our selling price or we change the number of units we sold. Or we can see how our selling price or volume of sales should be adjusted if our costs were to go up. The tool we use to analyze this is called cost volume profit, or CVP. One of the key concepts in a CVP analysis is determining the contribution margin. And we can look at contribution margin 3 different ways. We can look at it in total, by unit, and as a percentage. So for example, let's assume that Radial Company sells radio component parts. Radial had sales of $2.4 million during the first quarter, and that equated to 300,000 units that they sold. Below here is all of the cost data for the quarter. You've got cost of goods sold and selling and administrative expenses, and they're broken out into variable and fixed costs. The $920,000 of cost of goods sold that's variable would include things such as direct labor, direct materials, and overhead that would vary with the number of units produced. Remember, the definition of a variable cost talked about last week is that it varies with volume. The fixed component of cost of goods sold would include things such as depreciation on the plant and equipment, also rent expense if the plant was perhaps not owned, supervisor salaries that would not vary with the level of production, and property taxes on the plant, which would also be a fixed item. The $70,000 of selling expenses are variable, and that will include things such as sales commissions, which would vary based on the volume of sales. And the $45,000 of fixed selling expenses would include things such as the fixed salaries for the sales department. Administrative expenses include $90,000 of variable costs, and they will include things such as bonus payments that would vary based on performance, or overtime expenses that vary depending on the workload of the associates, or utilities such as the water bill that varies depending on how much water we would use. And the fixed component of administrative expenses would be things like the CFO salary or the receptionist salary, things like that would not fluctuate but be fixed. Now let's calculate the contribution margin for Radial. So in order to do that, we will take our total sales of $2.4 million and subtract our variable costs. So $1,320,000 is contribution margin. Now again, we can look at this in a couple different ways. The next way we'll look at it is as a percentage. So we take the contribution margin dollars and divide that by the sales, and that gives us a percentage. In this case, it's 55%. So for every dollar of sales, 55 cents is our contribution margin. That will go to cover our fixed expenses, and anything else that's left above and beyond fixed expenses will give us profit. So next, to calculate contribution margin per unit, we'll take our total contribution margin dollars and divide that by the number of units we sold. And so for each unit we sell, we contribute $4.40 to fixed expenses and then profit. The other way to calculate contribution margin per unit is to take the sales price per unit, which we calculate that with total sales divided by total units, and that is $8. So each unit is sold for $8. And we will subtract variable cost per unit from that, which again we can take total variable cost and divide it by units sold. That's $3.60. So the contribution margin per unit is just the difference between the sales price and the variable cost per unit, or $4.40. Again, the same number we calculated above, just a little bit of a different way to do it. Now that we understand contribution margin, we can look at CVP income statement. So what a CVP income statement is just a different way to look at the income statement than we would traditionally do it, and it's a way to break out variable and fixed costs and help us analyze our costs a little bit different, or see our costs in a different way, and it also gives us a contribution margin measure that we just calculated. So you would take your sales, subtract out your variable costs, that gives us our contribution margin, then take out our fixed expenses to get our net income. So we fill this in for Radial. We calculate that same contribution margin of $1,320,000 that we did above, but then we're going to also subtract out fixed expenses. So they made $737,000 of net income for that first quarter. The next thing we'll do is we'll look at break even. So here what we want to do is calculate the number of units that they would have to sell in order to break even. And that means that they would have no income or no loss, so essentially not making money and not losing money. So using the equation from the reading this week, what we'll do is we will solve for that number of units, and the equation would say, let's have 0 profit, and we'll take our price per unit times number of units and subtract from that our fixed costs and also our variable costs times the number of units. So for radio, we know it's $8 per unit times the number of units is how much we're going to generate in sales. And our fixed expenses are $583,000, and our variable costs are $3.60 per unit times whatever number of units we'd have to sell. Now if we solve for units, which we're doing here, we will be able to see exactly how many units we need to sell in order to break even. So let's just have Excel calculate that for us here quickly. So 132,500 units. Now if you look at this formula, essentially what we're doing here is we're taking our fixed costs and dividing it by our contribution margin per unit, which is the $8 minus the $3.60. So a shortcut way to do this formula to solve for units is take fixed expenses and divide it by contribution margin per unit. So again, having Excel calculate that for us, we'll get the same answer we got above, which is 132,500, and that's the number of units. Now the next thing we can do is look at our CVP income statement, but calculate it for our break-even sales, just to kind of prove out that we wouldn't make any income or loss if we sold at those break-even number of units. So 132,500 units at $8 a unit gives us sales of $1,060,000. We'd have variable costs at $3.60 times that number of units. So our contribution margin, $583,000. So sure enough, that's just enough to cover our fixed expenses, which we can actually link in from above. There we go. So 0 income, 0 loss. That's what we had expected. Now the other thing we can do with CVP is calculate our target profit. So here what I want to do is I want to know how many units I need to sell in order to earn a specific amount of profit. So in addition to the $583,000 of fixed expenses, I also want to generate profit. So say I want to generate $385,000. So I'm trying to figure out how many units I need to sell. I'm going to use the same equation above, but all I'm doing is adding in that target profit. So what that's going to do is give me 220,000 units. So how much in sales is that? 220 times $8 is $1,760,000 in sales. So if I sell $1,760,000 in sales, or 220,000 units, I will generate $385,000 of profit. Remember, above we calculated our break-even, $1,060,000. So if I sell only $1,060,000 in sales, or 132,500 units, I won't make any profit. Now the difference between these two numbers is called a margin of safety. So margin of safety, what that does is it calculates the difference between my expected sales level. So we'll say that this $1,760,000 is what I would expect. I think I can sell 220,000 units, and so that's what I'm going to say I expect or budget for my sales. I compare that to what my break-even sales, and the difference between that is my margin of safety. I had one student refer to this margin of safety as how much I can miss my budget by without losing any money. So let's go ahead and calculate that. So we can do it in sales dollars, which again is just going to be subtracting these amounts. We can do it in sales units, which is that $700,000 margin of safety dollars divided by unit price, so 87,500 units, or again we can look at this as a percentage. So we can take the 87,500 divided by the number of units we budgeted or expected to sell, and we've got 40% margin of safety. So we can miss our budget or our expected sales by 40% before we would lose money. So this covers the basics of CVP. In your textbook there's a really nice example that applies CVP when you have multiple products. The main difference with multiple products is that you have to apply a sales mix percentage. And in the example we just went through, we only assumed we had one product. But in multiple product CVP, we assume there's a single sales mix, but there's multiple products that make up that mix. But that sales mix is a fixed percentage. So this just is one limitation of CVP. In this example, one product, or when you use sales mix, it's one fixed sales mix. Volume is also a factor that's changing in this, but we don't assume any changes in the variable cost per unit or the fixed cost. Those are unchanged. So there's some limitations to think about with CVP, and your book discusses several of these limitations. However, limitations aside, it's definitely still a useful tool to help answer important marketing questions.